Welcome to the Beyond the Numbers podcast. Before we dive into this episode, we want to share an important disclaimer regarding the content of our discussions.
Okay, welcome to the latest Beyond the Numbers podcast. This latest one is one that's come up quite a bit in conversations with clients, hasn't it, Julian? It's for clients who basically are creeping over that 100K earnings threshold, and we're going to sort of talk about the impacts of that and some of the potential solutions that are available to mitigate that.
Yeah, I mean, it seems to be as we're getting into certain sectors, you get this £100,000 a year income issue cropping up. It tends to be around probably pharma and tech, I would say. And that's where we're stumbling across it, aren't we, really?
Yeah.
And the problems exist again. We've seen this like loads of times where the same problems keep repeating. And I don't think people are very aware. I'm not finding massive awareness, I don't know about you, on this kind of stuff.
No.
And I think often it's because someone's just crossed into it as well.
Well, it's a big point that because people who ultimately you might not have previously thought would creep into those earnings thresholds because of wage inflation and the fact that the bands have been frozen, which means people are earning more, but they're being taxed more. Means ultimately more people are crossing over £100,000 worth of earnings. And also, it's worth pointing out it's not just earnings, is it? It's not just people think oh, it's just the salary, but you start adding bonus and other bits and pieces onto that, other benefits. It's becoming more common that people are crossing into 100K.
And I think it's the point where they're sometimes at the crossroads that seems to they're not necessarily armed to think what the implications are. And I think then because you know, if you were that person that suddenly you've gone from 90 to 110 grand a year, all you think is I've got a 20 grand a year pay rise and
Yeah,
my life's progressing. And you probably, I mean, a lot of people think the obvious stuff like, oh, I'll overpay a loan off, a credit card down, or pay a mortgage off,
yeah,
or overpay on a mortgage. And then the issue with that is obviously the cost of them overpaying that mortgage by going the obvious route. It's costing them 62%, depending on how things could be done with workplace pensions and tax relief and things like that. But it's costing them a minimum of 60%, isn't it, really?
yeah. So that's the reason that 100K, just to lay the table a little bit, the reason that 100K is so prominent is because at 100K you start losing the personal allowance. So for every £2 of over £100,000 you earn, you lose £1 of personal allowance. And that basically what all of that means is that you go from being taxed at 40% to 60% effective tax rate. And it goes under the radar because it's an effective tax rate rather than there's no headline tax at 60%, but it's just the impact of removing certain allowances that causes it.
I mean, for clarity, your net income is 40% roughly of your
Mm.
gross
Yeah.
on everything above 100K, really, which is, when you spin it that way, it almost sounds worse, doesn't it? On a lower figure, because it obviously thinking, well, you're getting less than half.
Well,
of-
so I've seen it's crept into the media a little bit, and for all the reasons that we've been saying, it is becoming more common, and people are turning down pay rises and sacrificing bonuses or deferring bonuses because they don't want to cross that 100K threshold.
Yeah, I mean, we're probably seeing pension contributions, aren't we? Because we've got a lot of this kind of makeup of client. Um, so we're sort of seeing them. It's like pushing them to speak to us about, or it's like a trigger really for them to speak to us about pension because they're weighing up. What do they sacrifice into a pension to versus, it's hard to just instantly work the maths out, isn't it? Or how will it affect my net income versus if I just keep the 20 grand extra money because I was earning 90, I'm now earning 110 grand a year.
Yeah.
And I think it's hard for people to visualize the impact of it in the net income because
Yeah.
it's percentages and how does it affect the allowance? And it's all a bit, I mean, even for us, sometimes you can easily get the figures wrapped in a few knots.
Yeah.
rather than be able to articulate them in your mind. But
But
you've got some slides, haven't you, that sort of show it more
yeah,
clearly.
we go into those. So
I mean,
let,
let's not forget, there's ways around this. There's ways around the problem,
it's planning
and I
off.
think that's what we'll discuss when we've seen the slides, just to illustrate the impact of the actual tax.
So let's just start with this one. So this one, hopefully people can relate to. So this shows marginal tax rate. So people will be aware that they're taxed at 40%, and this is income along the bottom. So £90,000, you're taxed at 40%. When you get to this £100,000, because of the loss of the personal allowance, you start creeping up into a 60% tax effective tax rate. And it doesn't it stays the same, stays the same, stays the same till about 125 grand, where all of the personal allowance is lost, and then the effective tax rate comes down to the 45%. So it's where people are usually aware of being taxed at, 20%, 40%, and then 45%. But unless you're engaged with it, a lot of people don't realize this big bit in the middle, which is 60% tax burden is colossal, isn't it? You mean you're working to basically pay the government more than you're paying yourself.
And I think that's the context that people need to almost be spurred into action to actually sit and, well, even if they just let us work figures out, show them the impact,
Yeah,
make a few decisions, then actually could they run the life around it better, I would
yeah,
say. Because it's an extreme cost, isn't it? I
it is. It is.
mean, how
It's
many people moan about the cost of food going up and everything else going up? You compare it to this, it's insignificant.
it is. It is. But these are sort of some of the big choices you make along your financial journey that will have massive implications as to what happens to you later on because of the compounding effect of doing one thing over the other. It's colossal.
Yeah, I mean, we've spoke about that in previous podcasts, compounding and starting early and all that. But I mean, imagine this: start early and compound on this level of tax.
Yeah,
The impact to just what you can leverage into your retirement and stopping work early, a stroke, just the impact, really. There's nothing else you can really.
yeah. Well, I mean, some of the solutions that we'll come on to talk about a bit later on evolve mainly around putting money into your pension. That's one of the main things you can do to mitigate some of this. But as you say, if you're a fairly young person earning 100 over 100k, the impact of the tax saving, which actually physically puts more money in your pocket because of that effective tax rate, on top of the effective tax relief on the pension contributions, and then the compounding effect over time, it can either mean you retiring a number of years earlier, or it can mean you spending a lot, being able to spend a lot more money in your retirement. So it's life-changing advice, really.
Yeah, I mean, arguably it's probably one of the larger impact pieces of advice we give that we probably don't give it enough credit for because at the end of the day, and let's not forget, only 4% of the population earn 100k or more.
Yeah,
But for whatever reason, again, maybe the sectors we operate in, we are obviously dealing with a good proportion of
yeah.
4% based on what we seem to come across. So yeah, I mean
But then
in
again,
regions,
but
it's
then
common.
again, as we sort of touched on earlier, how you must be seeing people as well who are crossing that 100k that would you wouldn't really that are operating in sectors or in jobs that you wouldn't previously have thought would be earning 100k.
I mean, I would say it sometimes surprises me what some people's wages actually are
Mm,
based on the job. You can't go for job title sometimes. Traditionally a job title suggested an earnings band.
yeah,
You could have somebody who's a sales manager, which you think, well, sales manager, you'd expect to be what, 50 to 100k a year maybe, and they could be earning 200, 300, because it depends on the team that they manage and what
yeah,
that team do. And when you get into pharma world, tech world, some of these teams are doing quite specialist, almost niche type things in those industries that you don't even know, sometimes even, it staggers you that they even exist because you probably weren't aware of it because it's not like an everyday scenario. And yeah, I mean, the incomes in the team alone, when you look at that, nearly all of the team could be on 100k plus.
yeah,
And I think that's when you realize when you've got, say, a team of 5 people just from speaking to one client, the 4% side of it goes out the window for us because we're in groups of people that are in these pockets.
Yeah.
I think that's why we felt we ought to try and get this podcast out, really.
So there's a couple of other graphs that we'll just sort of bring up. So this is the net income that I was just referencing. So the purple line is the effect of not making a pension contribution when you sort of cross that again, that 100k to 125, 130k. The effect of not making a pension contribution keeps your net income here. Making a 10k pension contribution increases your net income because of the saving on the personal allowance or the keeping of the personal allowance.
And I think that's when people on a certain threshold won't realise that you're almost increasing your net income paying money into a pension.
Yeah.
This, they would see it as the sacrificing some of their actual net income.
Yeah.
And that's what I find when I'm speaking to people. That's the general sort of vibe, really, of what they think.
Yeah, because it almost sounds too good to be true, doesn't it?
Well, it's a bit like non-compute, isn't it? It's like hard to wrap your mind around.
Yeah. But those sort of
Paying.
cliff edge, those sort of cliff edge points in taxation present huge planning opportunities. So it's worth, one of the big takeaways is it's worth having a look at where exactly you are, having a look at your paychecks, having a look at, your income, adding in bonuses over time, all of that sort of thing, and seeing where you are. And then it's worth having a chat to see whether you are at that cliff edge or any of those cliff edges where there are planning opportunities to be had and money to be saved.
Yeah, I mean, I think there's some less obvious ones as well. So I think maybe start with the obvious ones that you can reel some of those off, and then I've got some in my head that are a bit less obvious. That obviously I see a lot of people either come and they're triggered to ring us up, and they often mention some of the obvious ones as a could I do this and would it do this kind of conversation. But I've got some that then you think actually a lot of people don't do, even though, or they don't go far enough, and they end up in a situation where, because for some reason they're not maximising the tax relief offset. Because I think too many people focus on just pension contributions on themselves.
Yeah.
Where would you start? What would be your first port of call?
I think pension contributions has to be the first place you'd start because you get the tax relief on the contribution going in. It's going into a tax efficient wrapper, which means that you're building money for your retirement in a tax efficient way. And also you get the tax saving on your income.
I mean, like you've already said, even 10 grand into a pension, once you're over 100 grand income,
Mm.
your net income increases. So your pension's sort of free, isn't it?
Yeah,
Or your pension contribution is free, that extra.
yeah. And more so because and then you start looking at national insurance savings as well. So if you've got salary sacrifice available, then that adds a little bit extra. So you can save, your 2% national insurance, but also the employer makes a significant national insurance saving as well. And some employers do pass that on to their employees. So then you add that saving on as well. And all of a sudden, what's already a really attractive contribution, there's a cherry on top as well, isn't there?
And I think, yeah, there's that bit. And then there's, let's face it, that's no hassle. It all gets done through payroll. All they have to do is instruct the pension company and instruct payroll. You know, how many times do we tell someone to do that? It's not about us getting someone to do a pension, is it? Sometimes we are telling them to top up their workplace scheme because we cannot compete with salary sacrifice. But what we can do then, and what it does bring attention to, is then what is that money going into? Which is
Yeah,
where it's obviously triggering the amount of people that come to me in this income bracket and say, I'm not sure my pension's performing well enough. And it leads to then this first, because this is more expensive than if the pension's not performing well enough. But if you put the two together and get both right,
yeah,
bearing in mind some of the funds are awful in workplace pensions, but obviously you can look at part transfer scenarios to get some money out whilst it still receives the contributions. But then you've also got default funds. Some of the default funds are better than others.
yeah. But it's
I'm not
also
saying they're great, but you go for what's best, don't you, with what you've got available.
You do. Some providers have quite a wide range of funds now, so there are alternatives to the default funds. So it's just about understanding what is available.
And I think that's where, we've been starting. You've been doing some bits for me on analysis because we're leading up to stuff like this. And the reality is, a lot of the default funds, or even just the funds in workplace pensions, group schemes, they're either too expensive or they're not up to scratch.
Yeah,
And it's led to them opening up these kind of conversations then on tax, income, tax relief. And you look at the overall cost compounding up, it's probably more than 60%, isn't it, with performance as well over, you look at it over 5 to 10 years, it could be like what, 80, 90% cost because of the performance hit as well.
yeah. And that's the benefit of taking bespoke advice, isn't it?
That's the benefit of just having a chat to start with, isn't it? Well, I mean, we could probably deduce some of this now from having a chat because we do so much of it.
Yeah,
We barely need to sit down with someone to know what workplace pension you got. Yet we've analysed that. We're starting to get so much intelligence behind the scenes on different schemes that it's getting to the stage where we almost know straight away.
mm,
You can almost give someone a ballpark.
yeah,
And I think that's the benefit we've got now. We don't have to sit down for 2 hours, do we, with somebody?
no,
We could have 10 minutes phone call and know roughly what we could do in this area.
yeah,
And I think it gives people probably a little bit of a lesser barrier to shout up and have a chat
yeah.
because not everybody's got 2 hours, have they?
No, indeed, indeed. But also,
Especially in this area.
yes, yeah. But it's just worth pointing out again that 100K threshold doesn't sound like it might not sound like it's for you, but it's really worth having a check as to see how much you're actually earning because once you start adding share options, commission, bonuses, you can perhaps not realize you're there.
But it's not just that, Phil. Think about it another way. Even if you're earning 60,
Yeah,
a lot of this applies. It's just scaled down
yeah,
slightly,
yeah,
but it's comparative to that person. If then it saves them 45% in NI and tax, there's
yeah,
still, it's still getting near that 50% of your income threshold, what you're probably blowing to HMRC, and then you're still putting it into a workplace scheme of some kind, possibly that's average,
yeah,
or you've just not looked, or it's not aligned to your attitude to risk or whatever it might be. And you think, well, actually, that's still a cost, even if you're earning 25, 30 grand a year. It's all comparative. It's more costly to each income band because they earn less.
yeah,
And I think that's when people look at a podcast like this, and I think whether you earn 25, 30 grand a year or 200 grand a year, it's the numbers are just scaled down or scaled up.
yeah,
But the same thing sort of applies. It's just not as dramatic.
for sure. Yeah, for sure.
And I think some of the less obvious things that I think are underused are, example, you've got a person earning 150,000 a year. You have a conversation with him. He buys into the conversation, says, "Well, yeah, I may as well sacrifice up to 60K limit on my pension contributions." Even then, you then obviously get paid your income, having been taxed on a good proportion of it. You still get a situation where he might have a partner, a wife, or something, or even children, and all of them can have pension contributions. So if you're in a position where you don't need the money net and you're just going to spend it on nothing, you can still, put money in your wife's name or your partner's name, and you can still then think, well, I'll put small amounts into my children's name and set pensions up for them. Obviously, less it doesn't affect your retirement on your children, but what it's doing is transferring wealth, so it then has a bit of an impact later on inheritance tax potentially. And you tend to find with people that earn these amounts, you do tend to get inheritance tax problems nearly always.
Yeah,
Um, Child benefit obviously is one issue as well that people forget at the 50 and 60 grand sort of area.
yeah,
50K it tapers, 60K it's clawed back. So, you know, all these things sort of add up, don't they, in different scenarios. And I think if you can use every allowance that every person in your household's got, they're the less obvious things that people don't often do
Yeah,
because I don't think they think about their wife offsetting by getting tax relief the tax that they're paying. They
yeah.
just think about their wife or their partner in the wife's terms and their pension terms. And again, how many times do we deal with one person and then not both people initially? And then we try and move it sideways a bit because obviously they don't retire on their own, do they?
No, well, the
And
impact we have is better, isn't it, when we're dealing with both partners?
yeah, and it causes less problems in the future, less arguments over money, less imbalance, more tax allowances are used, plus in retirement.
Yeah,
They're just little impacts that just add up so much money.
yeah.
And we don't really like working for giving money away, do we?
No, no.
Unnecessarily. The other less obvious thing that it's not so much a tax relief one, but it's again, people think all pension because they're going for the greed part of it of I want more tax relief, and then they don't max their ISAs out, which is still, tax efficient. Yeah, you don't get the relief, but you do get the tax-free growth.
Well, you don't get the relief, but also we're talking about income tax problems now. If you have some money in your ISA as well as a pension in the future, you can sort of blend your income. So you get a combination of taxable income from your pension after you take any tax-free cash and tax-free income from your ISA. So then you can start getting a higher level of income for without paying more tax.
And obviously, once the allowances are rolled over, they're gone.
Yeah,
Each tax year rolls, your
yeah.
ISA allowance is lost. I think this is not so much a like a tax relief type benefit, but something that often I see as well is people don't understand the implications of protection once they get to big incomes.
Hmm.
So what they don't really, they think they're less in need of insurance to insure their income because obviously they're earning more money, they feel safer, more secure financially in many ways. The reality is, every 10 years on £100,000 a year, you're turning over 1 million. So
Yeah,
obviously, if you've got a younger family, someone reliant on you, or you've got a partner or a wife that doesn't earn that amount, suddenly, you know, someone dies sort of 15 or 20 years into a dependency, it's 1 to 2 million just in actual pure income.
yeah,
And then, we'll stumble across them, I don't know if you have, where they've got like 150, 200 grand's worth of life cover and stuff. Or they say, oh, I've got a death in service. That's like 4 times at max.
yeah,
That's 4 years. And they think that's enough.
yeah.
So I think there's a little issue there that's under talked about, particularly in our remit, 'cause obviously everyone talks about accumulation, not spending money on insurance. And I think the other one is they forget that they should and really ought to do a tax return every year. Because obviously, if you don't do a tax return and your tax code goes adrift, you've got the problem of then you could be where 1 year you get a tax bill that you're not expecting because HMRC are getting sharper on this.
Yeah.
31st of Jan, tax return. I don't know if you had any inquiries about this, but must have done 10, 20 in the last, just sat with people and gone through it online just because it's numbers in boxes. So, people find it daunting. You don't need an accountant necessarily to do a personal tax return. Often they are quite basic, um, particularly if you're employed. Obviously, self-employed, bit different because you've got things you can offset more so. But yeah, that's all of it added up. It's the support's there, isn't it? You've just got to work out where you go for it.
Yeah, and it's as you say, once you start scratching the surface at what seems to be the problem or the headline issue, there's so many things that sprout out of it.
Yeah, I mean, it just grows arms and legs.
And you just can't Joe Public can't be aware of all of those things.
Well, to be honest, and this is where it makes you realise sometimes the minute you've got to talk about it, it makes you think about some of these things.
Mm.
Where before, like I could easily have had a phone call this morning before I thought about these things and not mentioned a lot of these things.
Yeah,
So if that's me and that we're doing it, you know, sort of for a living, it just makes you realise what the public possibly wouldn't be aware of just because it's not their job, is it? It's
exactly.
But yeah, have you got any other slides you want to show us, Phil?
No, I think that's covered
Pretty much
everything.
covers it, I think.
Yeah. I mean, a lot
So
of it's
should
very, very tailored and very nuanced, so it depends on individual circumstances. But those, hopefully, that just gives you a bit of a flavor as to why that is a big issue, and then we've started to talk about some of the things you can do to reduce the impact of it.
I think really all that's left to say is thanks for listening.
Yeah.
We'll see you on the next podcast.